Welcome to Porzio Planning. My name is Crystal West Edwards, and I'm a principal here at Porzio, Bromberg, and Newman. The topic for our discussion today is my most frequently asked question: will the government take my home? Before answering that question, Genworth Financial provides a number of statistics that are very helpful to keep in the back of our minds as we talk about long-term care and long-term care costs today. 70% of people age 65 or older will need long-term care services at some point in the future. 40%, however, of people currently receiving long-term care services are between the ages of 18 and 64. So long-term care and the anticipated costs of long-term care are not only a concern for our seniors, but are also a concern for individuals that are under the age of 65 that may require that higher level of service. Reasons to plan for long-term care include ensuring that you receive the best care possible in the best care setting possible, protecting assets for a community spouse, protecting inheritance for a spouse or other family members, avoiding estate recovery, which is the procedure by which a Medicaid agency would be entitled to be reimbursed at the time of your death for any benefits that it may have paid out for you during your lifetime. Another great reason to plan is to avoid the burden on children when caring for elderly parents. Ways to pay for long-term care include out-of-pocket private pay, Medicare benefits, long-term care insurance, veteran benefits, and benefits available through the Medicaid program. For purposes of this discussion, we are going to focus on the fifth bullet point, which is the Medicaid program. We jump to the Medicaid program because Medicaid is always the payer of last resort. So when all else fails, the Medicaid program is available to supplement and greatly defray the costs of long-term care. When doing long-term care planning, it is always critical to ensure that that planning will not jeopardize one's eligibility for Medicaid benefits in the future, regardless of whether or not they feel that they have sufficient assets to avoid being on Medicaid to begin with. Before going through the Medicaid eligibility rules, we'll talk a little bit about the private pay costs of long-term care. In a home and community-based setting, primarily in-home, the cost could range between $3,000 to $5,000 per month, assuming that the person only required intermittent care and did not require care on a 24/7 basis. The cost in an assisted living facility, on the other hand, which is one step above home care, but one step below a nursing home setting, could range anywhere from $3,500 to $8,500 per month, depending on the level of care that is needed, which is the amount of assistance that the employees and staff at the facility would be required to provide to you. In a nursing home setting in New Jersey, we're looking at a cost of anywhere from $10,000 to $13,000 per month. That's going to depend on whether or not one has a shared room or a private room, but it can be a pretty significant cost. For people who are insistent upon home care and would like to make that care setting work, regardless of the level of care that is needed, it's important to keep in mind that while the intermittent care could cost anywhere from $3,000 to $5,000 per month, 24/7 care could easily reach, if not exceed, the costs of a nursing home setting. 65.7 million Americans, which is approximately 29% of the population, serve as caregiver for an ill or a individual with disabilities that is in their family. 43.5 million of adult family caregivers care for someone 50 years or older. 14.9 million of adult family caregivers care for someone who has Alzheimer's disease or other forms of dementia, and approximately 2/3 of family caregivers are employed full or part-time. We thank the Family Caregiver Alliance National Center on Caregiving for providing us with these statistics, but it really shows you the impact that long-term care has on so many of us. In order to qualify for Medicaid in New Jersey, the applicant must be found to be either aged, blind, or disabled. For purposes of the definition of aged, one has to be over the age of 65. They must be a U.S. citizen or a resident alien, a resident of the state of New Jersey, which simply means that they are here and intend to stay here for a 30-day period, and also be found both financially and medically eligible for the program. Medical eligibility can be established by showing that the person requires assistance with at least 3 activities of daily living. So if mom needs help cooking and also needs help cutting up her food, allowing her to eat, may need help getting a shirt over her head, and assistance exiting the shower, those would be 3 activities of daily living in which would qualify her for Medicaid benefits. For financial eligibility, we're going to primarily focus on the Managed Long-Term Services and Supports program because that is the program that provides an institutional level of care for people who require the assistance of another person to perform those activities of daily living that were mentioned. In order to qualify for MLTSS, there's a twofold assessment that's done from a financial perspective. First, we look at whether or not their income exceeds the income cap. For 2020, the monthly income cap is $2,349 per month. If, on the other hand, someone has even $1 over that income cap, they can still qualify for Medicaid, but in order to do so, they must establish and fund a qualified income trust. There's a resource limit for people who are applying for the Medicaid program. So first we look at income, then we look at resources. Resources is everything other than income. It could be a car, it could be a house, it could be life insurance, bank accounts, savings bonds, CDs, fancy jewelry that's in the home. The resource limit for the Medicaid program for a single person applying is $2,000. If, on the other hand, a couple is applying, in which both of them would be receiving services, the resource limit is a combined $3,000. When someone is applying and they have a spouse, only the spouse's income, only the applicant's income is counted. The spouse's income is considered exempt and is not on the table for purposes of establishing their spouse's eligibility for Medicaid. Resources, on the other hand, are pooled together. So if spouse 1 has $200,000 and spouse 2 has $200,000, then for purposes of applying for Medicaid, if spouse 1 is the person who's applying for services, spouse 1 will be viewed as having $400,000 of resources. When qualifying for Medicaid when one has a spouse, the general rule is that the spouse is entitled to keep 1/2 of their combined assets. However, there's a but in the middle of that. And so the spouse can keep 1/2, but the spouse cannot keep more than $128,640. What that means is that if a couple had a combined resource allowance of a combined amount of resources that reached, let's say, $250,000, then the community spouse would only be able to keep $125,000, 1/2 of $250,000. On the other hand, if the couple had, as in my first example, a combined $400,000, then the spouse would only be entitled to keep $128,640. This is the figure in 2020, and that number does get adjusted each year. It is important to note that in addition to the community spouses resource allowance, the Medicaid applicant can also have no more than $2,000. The primary assessment that Medicaid does when dealing with a spousal situation is to determine whether or not the spouse would be entitled to a spousal allowance or a monthly maintenance allowance from the ill spouse. So let's say, for example, spouse one is applying for Medicaid and they have $2,000 of monthly income. However, spouse two, who is well and is still going to be in the community, only has monthly income of $1,000. In that circumstance, the Medicaid agency would allow at a minimum $1,113.75, which is the difference between the monthly maintenance allowance and spouse two's income, for purposes of ensuring that the well spouse maintains at least the minimum monthly allowance figure from an income perspective. When we talk about that resource limit and spending down one half up to those thresholds, it's important to note that we're only talking about resources that are countable by the Medicaid agency. Countable resources are all resources that are not otherwise excluded. And so we're going to talk about what those excluded assets are. It's important to note, however, that the eligibility rules that we're talking about only apply to the New Jersey program. There are different exemptions and different assets that are considered countable in the state of New York and in Pennsylvania. While our Porzio planning team can assist you with long-term care planning in both of those states, we will not be discussing the eligibility rules for those programs during this discussion. Excludable resources include a car, personal effects and household goods, not to exceed $2,000, a $1,500 burial fund or a reasonable amount, and reasonable is what the Medicaid agency determines to be reasonable, that's placed in an irrevocable prepaid funeral trust or in another prepaid irrevocable funeral arrangement. Life insurance policies that are term policies have no cash value and therefore are not counted towards your countable assets. The cash value of life insurance, if the face value is no more than $1,500, is also excluded. However, it is important to note that if let's say the Medicaid applicant has more than one, let's say they've got 3 life insurance policies and each one has a $1,500 face value, that would mean that the collective value of their life insurance, in my example, is $4,500, and therefore all of the cash surrender value for all 3 of those policies would be counted. So it's important to look at what the life insurance policies say, what the face values and fair market values and cash surrender values are, so that one could determine whether or not the life insurance policies would have to be spent down or whether they would be considered excludable resources. A primary residence is an exempt resource up to an equity value of $893,000, provided that that home is occupied by a community spouse, a disabled child, a caregiver child that meets specific exemption rules for that type of exempt nature, as well as a sibling with an equity interest. It is important to note here that a primary residence is not excludable in New Jersey if it is owned by an applicant who does not have a spouse or disabled child or sibling with an equity interest living in the home. What that means is that if a single person is applying for Medicaid and owns a primary residence, that home would have to be listed for sale, and the sale proceeds, once the property is sold, must be reduced below $2,000 in order to qualify the person for Medicaid benefits again. This is the biggest consideration, and this is really at the heart of the question, will the government take my home? The answer to that question is no. The government will not take your home. But what the government will do is the government will say that they will not provide long term care coverage for you to be paid by the Medicaid program unless your house has first been sold and the sale proceeds utilized to cover your long-term care your long-term care needs first. For this reason, it is critical to begin to plan sooner rather than later so that the home can be protected and the likelihood that it would have to be sold can be significantly reduced. Once someone has established that they meet the income and asset limits for the Medicaid program, the agency will begin a 5-year audit. That 60-month period, that 5-year period, is called a look back period. And that's when the agency is looking for gifts that may have been made or uncompensated transfers, which just means things that you can't explain as being purchases for fair market value. And roughly for every $10,702 that has been given away, it will equal 1 month of no Medicaid. This is a very important consideration and the primary reason why families should not attempt to do a Medicaid plan without the counsel of a certified elder law attorney. For example, if a family decided to transfer the primary residence to their children that had a value of $300,000 and they then applied for Medicaid within a 5-year period, it would mean that on the first month that they have been found to be eligible for Medicaid, which means they have spent down their other assets, they have met the income, the resource, and the medical criteria for the program, and effectively are destitute and need those benefits, that's the time that the transfer penalty would begin. And for a transfer that's valued at $300,000, you would be looking at roughly 2.5 years of no Medicaid. There are certain transfers that are exempt that are not subject to that transfer of assets rule that I just mentioned. That would include transfers to a community spouse, transfers to a disabled child, or to a trust for the benefit of another individual with disabilities. Transfers to a child that are under the age of 21, transfers to a spouse, a disabled child, a caregiver child, or a sibling with an equity interest are all exempt transfers specifically for real estate transactions. The one that I'm going to highlight here is a transfer to a caregiver child. This is also a very frequent question that I get. I've heard that I can transfer my house to my kid if they live with me for 2 years and they take care of me, then the government won't take my house. Well, that's not necessarily true. The criteria for the caregiver child exemption is pretty detailed, and it's not just that they lived with you, but it's that they provided care for you that allowed you to remain in a home setting and not on Medicaid benefits for at least a 2-year period. Again, a transfer of a primary residence, especially a transfer of a primary residence to a caregiver child, should not be done without the counsel of a certified elder law attorney. One mechanism of transferring a home is to transfer a home subject to a life estate interest. This is a transfer that provides a significant amount of protection for the senior. The reason that it provides that protection is because it is a way to transfer a home while at the same time maintaining a lifetime right to live in the home. In so doing, if the property is transferred subject to the retention of a life estate, and then a Medicaid application is submitted within 5 years of the date of that transfer, there will be a penalty period assessed. And that penalty would be based on the value that Medicaid attributes to the portion of the house or the interest in the house that was transferred. That's based on life estate tables. And so essentially, every passing year, the value of the life estate goes down and the value of the remainder interest increases. So a transfer penalty would be assessed at a higher rate for a younger Medicaid applicant than it would for a Medicaid applicant that was slightly older. If, however, an application was submitted at least 5 years after the life estate transfer, then the transfer is not on the table for purposes of being penalized, while at the same time, the home does not have to be sold the way that it would for an individual who is applying and does not have a um, child with disabilities, a sibling with an equity interest, or a spouse is living in the home. And it also would not be subject to the estate recovery rules at the time of their death. An important consideration here, however, is that the life tenant, the Medicaid applicant who has transferred their house but is keeping the lifetime right to live there, that also means that they are keeping the lifetime right to the rental income from that property. And they also have the obligation of paying the property taxes, maintenance costs, and other typical carrying costs for the home. For families where the home may have already been sold and you're looking at ways to preserve additional assets, one option is to purchase a life estate interest in the in the home of a child. A life estate purchase would be a purchase for value using those same tables that I just mentioned with Medicaid, whereby the older someone is, the less amount of percentage interest in the home Medicaid would attribute to that purchase. So, for example, if someone at the age of 75 was going to purchase a life estate interest in their child's home, let's use 40% just as an example of what the Medicaid agency would determine to be the value of that life estate. That would mean that if the life estate tables provided that a 75-year-old's life estate interest is 40%, then the Medicaid applicant essentially could purchase a life estate interest in their child's home that is equal to 40% of the appraised or fair market value of the child's home. In order for the agency to treat the life estate purchase as a purchase and not subject it to the Medicaid transfer of assets rules, the Medicaid applicant must reside in the same home with the child for at least 1 full year prior to applying for Medicaid benefits or going into a long-term care setting. Another option for transferring a home is to transfer it to a trust. There are two types of trusts that we're going to talk about today. One is a grantor trust and the other is a complex trust. A grantor trust has the greatest income tax benefits because the trust assets are taxed to the grantor as if they still own the money, own the property. A potential downside, however, to transferring a property to a grantor trust is that if it's not properly drafted and too many powers are retained by the Medicaid applicant, also known as the grantor, in this type of trust, then the trust proceeds potentially could be pulled back for estate recovery reasons. This is another critical analysis that we recommend is done by not only an elder law attorney, but one that has an intimate familiarity with avoiding estate recovery, income tax concerns, as well as any death tax concerns that may exist. However, for a grantor trust, it's very hard to ignore that because the income is taxed to the grantors if they still own the assets, they would also be able to utilize their personal residence exclusion, that $250,000 exclusion, for capital gains purposes. That is a great benefit for someone who may want to transfer their home, while at the same time anticipates that it's possible that the home could be sold during their lifetime. One thing I didn't mention earlier is that the life estate transfer works best when you do not anticipate that the home will be sold during the applicant's lifetime. A complex trust, on the other hand, the clear advantage to that is it wouldn't be subject to estate recovery in any circumstance. However, a major disadvantage is that because the trust is taxed as a separate entity, taxed separately from the grantor, you would lose the power to be able to obtain that $250,000 exclusion from capital gains tax when the home is sold. Another option would be to transfer the property to a third party donee trust. A third party donee trust is basically a trust that's set up by your intended beneficiaries. Usually it would be the children, for example. And the trust assets would be held for a period of time or as the trustee of the trust so determines for purposes of ensuring that the material purpose of the trust has been satisfied. The benefit of a third party donee trust is that the grantor, i.e., the Medicaid applicant, has no retained powers, no interest, no position whatsoever in that trust, while at the same time it can serve as a management vehicle for transferred property and other assets. When we're dealing with transferring a home to a third party donee trust, because with this type of trust, the Medicaid applicant would lose their right to that $250 personal residence exclusion. Sometimes we may want to use this option in conjunction with the life estate option to ensure that we maximize the capital gains tax planning that may be available. Just as a general overview of the tax consequences of the real estate transfers that we've talked about so far, if one were going to make an outright transfer to their children, for example, without retaining a life estate, without doing it in a grantor trust or any other type of trust instrument, then the outright transfer would result in capital gains tax to, in our example, the children when the home is sold. On the other hand, if the property is transferred subject to a life estate and the home is not sold during the applicant's lifetime, then the capital gains consequence essentially would be eliminated at the time of the applicant's death. On the other hand, if the home is sold during the Medicaid applicant's lifetime, the downside from a tax perspective is that a percentage interest of the property and the corresponding capital gains tax would be due by any children or family members that do not qualify for that personal residence exclusion. This could cause additional resources to be used to pay for taxes when in fact your intention was for all of the proceeds or a significant percentage of them to benefit your children. So we've mentioned estate recovery before. The only thing that I'll highlight here is that if a Medicaid applicant or a Medicaid recipient owns a home at the time of their death, the Medicaid agency is entitled to reimbursement for expenses that were paid out on his or her behalf during their lifetime. However, that recovery would be postponed if the home was being occupied by a surviving spouse, by a child under the age of 21, by a child with disabilities, or by a sibling that has an equity interest in the home. And again, there's no estate recovery if the applicant only owns a life estate interest in the property. Just generally, because we're also tax planners at Porzio Planning, I have to mention some of the estate and gift tax consequences of transferring assets. So, from a federal perspective, there's no estate or gift tax on assets that are passing to a spouse or to a charity. For all others, in 2020, one could give away just over $11.5 million and not be subject to any gift tax. For those who are already over that threshold of gifts, anything above that number would be subject to a 40% gift, estate, or generations giving transfer tax. Additionally, Each year, there is an exclusion from gift tax for each person that you were to provide money to. And that threshold in 2020 is $15,000. What that means is if you wanted to give $10,000 to a child in December 2020, you could do so without having a gift tax consequence. On the other hand, if you wanted to leave $25,000 to a child in December of 2020, when I say leave, I really mean in this circumstance, make a gift of $25,000 to your child in 2020, that would mean that 15,000 of that would be exempt because of the annual per donee exclusion, and the remaining $10,000 would be taken from your lifetime exemption of just over 11.5 million. The only consequence of this is that there would be a gift tax return that would be due by April 15th of 2021 in my example. For those that have not heard the news, the New Jersey estate tax was eliminated in 2018, and New Jersey has no gift tax. There is an inheritance tax in New Jersey that's based on the relationship of the person who's inheriting money from you. Spouses, children, stepchildren, grandchildren, parents are all exempt from inheritance tax. However, siblings, spouses of siblings are taxed at rates anywhere between 11 and 16% after the first $25,000 that passes to them. And all others, which would include nieces, nephews, cousins, friends, significant others whom you have not married, would be subject to a 15% inheritance tax that could increase to a 16% inheritance tax depending on the amount of money that's being provided post-death. My last note here is that transfers that are done in contemplation of death are still subject to New Jersey inheritance tax. What that means is if someone were to leave their entire estate by way of a gift during their lifetime to their significant other whom they never married, and then passed away a year later, the state of New Jersey would still impose an inheritance tax at a rate of 15%. On the other hand, if that transfer was done 3 or more years prior to date of death, then there would be no gift in contemplation of death, and therefore there would be no tax consequence of that transfer. We've discussed a number of issues throughout this presentation today, but the takeaway at this point is that if you have any questions with respect to your long-term care concerns, or maybe even the tax implications of implementing a long-term care plan, feel free to call me or any of our team members at Porzio Planning. We're here to help, and we look forward to hearing from you.